Hey guys, welcome back to another episode. In this video, we want to explain liquidity and show you how to use this concept on the chart to professionally understand the concept of liquidity. Whether you're a novice trader or an experienced professional, understanding and mastering liquidity is essential for consistent profitability in the financial markets. Sure. So, like the video and join me on this journey. Understanding the liquidity concept will instantly enhance your entries and exits, help you incur far fewer losses, and enable you to seize insane risk-to-reward ratio trades. So, what is liquidity? Liquidity essentially refers to money or large counter orders. Every trade is a transaction between buyers and sellers, so more money in the market facilitates trading for large players. Liquidity is a zone on the chart where a large pool of money is resting, such as stop losses and buy or sell orders. Now markets move due to orders and money and transactions taking place and passing hands in the market. They need liquidity. In other words, they need sellers or buyers in the market. The market continually seeks to absorb this liquidity to generate momentum essentially. Liquidity serves as the lifeblood of the market, playing a vital role in its overall dynamics and functioning. So, the question is, where are the liquidity zones? Before we dive into trading and trades, we must first identify obvious liquidity pools. These will be our closest target for the price to converge upon. Equal highs and lows, which mark significant turning points. Trend movement, where liquidity tends to accumulate below or above the trend line. Equal highs and equal lows, often identified as double tops and double bottoms in classic technical analysis. These levels are key indicators of market liquidity, serving as identifiable points of resistance and support. When we encounter equal highs, we see resistance. Conversely, equal lows indicate support. Traders often place stop-loss orders just above these equal highs or below equal lows, anticipating potential reversals. This practice underscores the idea that significant liquidity exists at these levels, which can attract large capital flows. These levels act as a gravitational force, attracting large capital flows and creating a significant amount of liquidity. We may have traders looking to buy breakouts if the market pushes above a certain level, which means we'll have an additional layer of liquidity here in the form of buy stops for breakout traders who expect to buy when the market breaks out. The same goes for support level or equal low liquidity. We will have sell stops here from traders looking to sell once the market breaks these equal lows. So what the support or resistance actually does here is formulate a lot of liquidity or orders above or below the level, which means we can use equal lows or equal highs for two different things. Number one, we can use them as validity targets. If we found a buying opportunity in the market here, we could use the equal highs or all lows as a target. Because we know the market is very likely to trade back towards these equal highs or lows. Now let's go over to chart and I'll show you a recent example that brings equal high and equal low liquidity into the picture. So next we're going to cover the trendline liquidity. Essentially, trend liquidity refers to areas where we expect a high concentration of orders. Retail traders often subscribe to the idea that a trend line represents a potential change in trend. The traditional approach is to wait for a retest of the trend line to sell or to look for a breakout and then a retest to buy. Let's break down the price action. Here, we can see a shift in the trending structure. We formed a high, followed by a lower low, then a lower high, and finally another lower low. This indicates that unless we break above the previous high, the trend remains bearish. A break of the trend line doesn't necessarily mean a trend reversal is imminent. With this understanding, we can focus on following the trend. Any movements around the trend line become context for liquidity rather than indicators of trend changes. So, what do we know about liquidity at this level? First, we have sellers at the trend line, which constitutes our first layer of liquidity. These sellers will likely have stop-loss orders placed just above the trend line. Next, we have breakout traders who are anticipating a push upwards, creating a second layer of liquidity with buy-stop orders. Lastly, there are manual execution buyers looking for a break and retest, adding a third layer of liquidity above the trend line. So, what's likely to happen? Often, the market will sweep through these liquidity zones, triggering stop losses and buy orders, only to reverse direction and move back down, liquidating buyers who entered after the breakout. This means that both sellers looking to sell the retest and buyers looking for a breakout can end up losing. So, how can we leverage this information in our trading? First and foremost, don't blindly trust trend lines. Instead, focus on the actual price action, specifically, the highs and lows. Remember, a trend line doesn't dictate the trend, it simply highlights areas of liquidity that could trap you into losing positions. To trade trend lines and trend liquidity effectively, always consider the underlying structure. As we've discussed, unless the previous high is broken, the trend remains unchanged. Additionally, keep an eye on supply zones, as they can provide further insights into potential price movements. Now let's go over to chart and I'll show you a recent example. I hope this video has been useful to you. If it has, please click the like and subscribe buttons to help us continue producing more videos like this.